Digital Assets for Investors. Chapter 6, Tokens and Digital Economies. Section 1, Utility Tokens. A utility token is best understood by asking what it lets a user do. Its main purpose is to function inside a blockchain-based product or service, giving access to something practical rather than representing ownership in a business. In that sense, it behaves more like a digital credit, pass, or usage tool than a share certificate. A token might be needed to pay for storage, unlock premium features, run transactions inside an app, or activate some other function in the system. Because of that, its economic relevance depends heavily on whether people actually use the platform. If the product is useful and the token is truly necessary, demand for the service can translate into demand for the token. If not, the word utility may be more of a label than a real economic driver. What separates a utility token from other digital assets is the role it plays. Bitcoin is often discussed as a payment asset or store of value, while Ether is closely tied to paying network fees and operating the Ethereum ecosystem. Governance tokens are mainly about voting power, and security tokens are designed to represent ownership interests or financial claims. A utility token, by contrast, is defined by what it enables inside a specific product. The focus is not primarily on ownership, legal rights, or governance authority, but on practical use. That difference matters because investors should evaluate it through product demand and user behavior, not just through broad crypto comparisons. In other words, the question is not simply what kind of token it is called, but what job the token actually performs. Inside a platform, utility tokens often sit at the center of the internal economy. They may be used to pay for services, unlock premium content or tools, cover transaction fees, or reward users who contribute something valuable. That contribution could be activity, participation, content, computing resources, or some other helpful behavior. The common thread is that users acquire the token because they need it for something specific. Strong utility usually means the token has a clear operational purpose that would be hard to replace without changing how the platform works. Weak utility appears when a token is added mainly for branding or fundraising, even though the service could function just as well without it. For investors, that distinction is crucial because real necessity is much more meaningful than a token simply being present. Many utility tokens are not launched on their own independent blockchains. Instead, projects often create them on existing networks, such as Ethereum, by using smart contracts. A common format is the ERC-20 standard, which gives teams a ready-made framework for how tokens can be issued, transferred, and tracked. The smart contract defines the token's rules, including supply, transfer mechanics, and sometimes reward or access functions. This approach is much faster and cheaper than building a separate blockchain from scratch. It also lets a project benefit from the security, wallets, and infrastructure of an established network. For investors, the important idea is that a token can be economically significant even if it is technically just one application built on top of a larger blockchain. Utility can matter because real usage can create real demand. If users must obtain the token to access a service they value, then rising platform activity may naturally increase token buying. But this only works when the utility is genuine and not artificially forced. A token that is technically required but easy to avoid, or tied to a weak product, may not generate meaningful demand at all. It is also important to separate usage from speculation. Heavy trading volume can make a token look popular, but speculation is not the same as customers needing the token for an ongoing service. The key question for investors is whether demand comes from users of the product or mostly from traders hoping someone else will buy later. Most utility tokens follow a simple economic cycle. First, the token is created and distributed to some combination of founders, investors, users, or community participants. Then the platform makes that token necessary for a defined activity, such as paying fees or unlocking access. Users who want the service obtain the token, and market price begins to reflect both available supply and the amount of real usage. If adoption grows, token demand may strengthen because more people need the same asset to use the platform. If adoption stalls, or if users can switch to alternatives easily, demand may weaken. So the critical link in the cycle is whether service demand truly becomes token demand. The Cloud Chain example makes utility very easy to measure. Suppose the SLOUD token has a fixed total supply of 100 million, with no additional minting in the future. If one Sloud pays for 1 gigabyte of storage for 1 month, then the token has a direct and transparent function. A user who wants 50 gigabytes of storage for that month would need 50 Cloud. That is a simple one-to-one relationship between service use and token use. Investors usually like examples like this because the token's purpose is concrete rather than vague. It does not guarantee value, but it does make the demand logic easier to analyze. From that example, you can see how usage might support price. If Chain has 10,000 active users and each uses an average of 20 gigabytes, monthly demand would reach 200,000 Cloud. If users regularly need tokens to maintain storage, that creates recurring demand rather than a one-time purchase story. When treatable supply is limited, increasing service use can support market value by putting more pressure on the available tokens. But this is only a possible outcome, not a guarantee. It depends on whether users truly have to keep buying the token, whether the service remains attractive, and whether the market expects future growth. Utility can support price, but only if the business and the token design keep working together. Even when a token has a real use case, several risks remain. The first is platform risk. The product may simply fail to attract enough users, which means token demand never becomes meaningful. The second is design risk, where poor tokenomics, large unlocks, or weak incentive structures undermine the value created by utility. There is also volatility risk, because if the token price swings sharply, the actual cost of using the service becomes unstable for customers. Regulatory risk matters too, since some tokens described as utility tokens may still draw securities-related scrutiny, depending on how they are marketed and structured. A useful product does not automatically create a durable token investment. That is why investors need to evaluate both the business and the token separately. To evaluate a utility token, start with the most practical question. What exactly does this token let a user do? Then ask whether that role is truly essential, or whether the platform could function almost the same way without it. After that, review supply details such as total supply, maximum supply, and future issuance or unlocks. Look at holder count, transaction activity, and evidence of actual platform use, because these can help distinguish real demand from promotional hype. You also want to know whether users come to the platform because they need the service, or whether interest is mostly driven by speculation about price. A strong utility token is economically necessary, not just well marketed. That mindset sets up the shift into governance tokens, where the token's value comes less from access and more from influence. Section 2. Governance tokens. Governance tokens serve a different purpose from utility tokens. Their main function is to give holders a voice in how a protocol or network evolves over time. That voice may include decisions about fees, software upgrades, treasury spending, or the addition of new features and markets. These tokens are especially common in DAOs and other community-led systems where decision-making is distributed rather than centralized. What they usually do not represent is legal ownership in a company or a direct claim on profits in the way stock might. So, when investors look at governance tokens, they should think in terms of influence and control, not product access or corporate equity. The value proposition depends partly on whether that governance power is meaningful and connected to an important protocol. The scope of governance can vary widely from one protocol to another. In some cases, token holders can vote on fee changes, which directly affects users and the protocol's competitiveness. In others, they may approve software upgrades, decide which assets or markets to support, or direct treasury funds toward grants, incentives, or ecosystem growth. These are both technical and economic choices, and they can shape the future of the network in major ways. But the exact authority depends on the protocol's rules, not on the token name alone. Some governance systems are broad and powerful, while others are narrow or partly symbolic. That means investors need to read the actual governance framework instead of assuming all governance tokens work the same way. The theory behind governance tokens is incentive alignment. Users may want lower fees, developers may want funding for upgrades, contributors may want support for growth, and long-term holders may care most about durable protocol health. A governance system tries to bring those interests into one decision process. If it works well, people who are economically connected to the network help make choices that improve its long-term resilience and competitiveness. But alignment is not automatic. It depends on token distribution, participation rates, and whether the governance design prevents a small group from dominating outcomes. So, governance can be a useful coordinating tool, but it is still a human system with trade-offs and power dynamics. One reason governance can be confusing is that several different rights are often bundled together conceptually, even though they are not the same. Voting power refers to how many votes a holder controls, usually based on token balance. Proposal rights determine whether someone can submit a proposal in the first place, and many systems require a minimum threshold for that. Delegation adds another layer, because a token holder can assign voting power to someone else without giving up the tokens themselves. In many protocols, influence is proportional to token holdings, which means larger holders have more weight. That can make governance efficient, but it can also create concentration risk. For investors, understanding these distinctions makes proposals and outcomes much easier to interpret. Most governance systems follow a recognizable process from idea to implementation. Tokens are first distributed across founders, investors, users, treasury accounts, or other stakeholders, and that early distribution often shapes future power. Eligible holders can then submit proposals, sometimes only if they meet a minimum threshold. The community reviews the proposal, debates it, and may revise it before a formal vote begins. If enough token-weighted votes participate and the approval threshold is met, the proposal passes. Many systems then impose a delay, often called a time lock, before the change is executed on-chain. That sequence matters because governance is not just about who votes yes or no, but also about who can propose, who shows up, and how execution is controlled. A successful governance vote usually requires more than the simple majority. Quorum sets the minimum participation level, so a proposal can fail even if most of the votes cast are in favor. Approval thresholds add another filter by defining how much support is needed among participating votes, such as a simple majority or a higher standard like 60%. Voting may be based on tokens directly held or on tokens delegated to another address. Many systems also use a snapshot, meaning voting power is measured at a specific block, so people cannot buy tokens after the fact to change the result. After a proposal passes, a time lock delays execution to give users and markets time to react. For investors, these rules often matter just as much as the proposal itself. The LendChain example shows several governance mechanics working at once. Alice holds 5% of the tokens, which is enough for her to submit a proposal to reduce lender fees from 10 to 7%. Bob does not vote directly and delegates his 3% voting power to Charlie, demonstrating how influence can shift without tokens changing ownership. Carol holds 20% and votes no, showing how a concentrated holder can still play a major role in the outcome. In the end, 45% of total voting power participates. Quorum is met, and 55% of those votes are yes, so the proposal passes. The 48-hour time lock means the fee change is approved, but not immediate. This is a good reminder that governance outcomes are shaped by proposal rights, delegation, participation, and concentration all at once. This exercise highlights a very important lesson. A majority is not enough if the rules require minimum participation. Suppose each swap token equals 1 vote. The total supply is 1 million, and quorum is 20%. That means at least 200,000 votes must participate for the proposal to be valid. If only 150,000 votes are cast, the proposal fails immediately, even if the vast majority of those votes support it. In other words, the yes versus no split matters only after quorum is satisfied. Investors sometimes overlook this and misread a proposal as having broad support when it actually lacked enough turnout. Governance analysis always requires both political support and rule compliance. Several common mistakes can distort how investors view governance tokens. One is treating them like equity, even though voting rights in a protocol are not the same as legal ownership in a company. Another is ignoring proposal thresholds, quorum requirements, and other participation rules that determine whether votes even count. Delegation can also be misunderstood, especially when holders assign power without examining whether the delegates' incentives are aligned. Token-weighted voting is not automatically fair either, because large holders may dominate outcomes, and even after approval, a passed proposal may still sit in a time lock before anything changes. A careful investor looks beyond token ownership and studies the actual control structure. Governance tokens can widen participation, but they do not guarantee wise decisions. Low turnout can leave major choices in the hands of a small minority, which weakens the idea of community control. Large holders or organized delegates may dominate outcomes, especially when token ownership is concentrated. Short-term incentives can also distort decisions if voters support changes that help near-term price at the expense of long-term protocol health. Complex proposals create another problem because many participants may vote without fully understanding the technical or economic consequences. That means the quality of governance itself becomes part of the investment case. When evaluating a governance token, investors should assess both the protocol and the governance system that directs it. Section 3. Tokenomics. Tokenomics refers to the economic design of a token and the system built around it. It includes how tokens are created, who receives them, how they are used, and whether some are later removed from circulation through burns or other mechanisms. In practice, tokenomics shapes incentives, influences behavior, and affects the long-term health of a network. Good tokenomics can encourage participation, utility, and sustainable growth. Poor tokenomics can create dilution, weak demand, or unhealthy short-term behavior, even when the technology looks promising. In many crypto systems, these rules are written directly into smart contracts, so economics is not just a policy idea, but part of the code itself. That is why investors should treat tokenomics as a core part of fundamental analysis. A simple way to understand a token economy is to ask a few basic questions. First, who receives the tokens, such as founders, investors, users, developers, or the treasury? Second, how do tokens move through the system? Are they earned, spent, staked, traded, or locked? Third, why would anyone want to hold or use them in the first place? The answers to those questions reveal the token's distribution, its flow, and the reasons demand might exist. They also help show whether the design relies on real utility or mostly on speculation. At the bottom of all of this are supply and demand, because tokenomics ultimately affects both how many tokens are available and why people want them. A practical tokenomics framework has 4 building blocks: supply, utility, incentives, and governance. Supply covers how many tokens exist, how new tokens are issued, whether tokens are burned, and whether some are locked or vest over time. Utility explains why the token is needed, whether for fees, access, collateral, discounts, or some other function. Incentives describe how rewards are used to encourage behaviors that help the network, such as staking, liquidity provision, or participation. Governance determines who can influence protocol decisions and how control is distributed. Strong tokenomics usually combines all 4 in a coherent way rather than relying on just one attractive feature. For example, scarcity without utility is not enough, and rewards without good governance can create long-term problems. Supply and demand are central because token value depends on both. If supply keeps growing rapidly, each token can become less valuable unless demand grows fast enough to absorb the increase. At the same time, scarcity by itself does not create value if the token lacks a strong reason to be used or held. Meaningful utility can support demand, but even useful tokens can struggle when issuance is excessive. The strongest designs usually balance these forces so that supply growth is manageable and demand comes from real activity. That balance is what makes tokenomics more sustainable over time. Investors should always ask not just whether a token is scarce, but whether anyone genuinely needs it. Projects often design tokenomics in stages rather than all at once. They usually begin by defining the token's purpose, because the rest of the structure should support that function. From there, the team sets supply rules and distribution plans, deciding how much will exist and who will receive it. The next step is building incentives that encourage useful behavior, such as staking, contributing, using the product, or securing the network. Then the project creates actual demand drivers so people have reasons to hold or spend the token beyond speculation. Governance is often added as the system matures, giving the community a role in future decisions. Good tokenomics is rarely static. It is designed, launched, monitored, and often revised over time. Stronger token design aligns individual rewards with the health of the network. Rewards should push people toward useful actions, not toward extracting value with minimal contribution. Utility should connect to real network needs, such as paying fees, accessing services, or posting collateral, rather than being artificially inserted. Emissions should also be controlled so that token rewards do not create relentless sell pressure that overwhelms demand. Governance should be broad enough to avoid excessive concentration of power because highly centralized control can weaken the long-term credibility of the system. In other words, a stronger design supports participation, usage, and accountability at the same time. That is usually a better sign than flashy rewards or aggressive marketing. StreamChain offers a useful example of several tokenomics pieces working together. The token, STRM, has a fixed supply of 100 million, which creates a clear supply boundary. Viewers spend tokens to access premium content, so there is an obvious utility-based source of demand. Creators earn tokens based on watch time, which creates an incentive for producing content that attracts attention. Stakers receive a share of fees and can vote on protocol rules, adding both incentive and governance dimensions. On top of that, 10% of content spending is burned each quarter, reducing circulating supply over time if platform activity remains strong. The key point is that utility, incentives, governance, and supply controls are all connected in one economic loop. Even in a thoughtful design like StreamChain, long-term value still depends on real usage. Quarterly burns can reduce circulating supply, but they only become meaningful if people continue spending tokens on content. If activity rises, burns rise too, which may support the token by removing more supply from the market. If activity falls, both demand and the burn rate weaken at the same time. That is why supply controls can help, but they cannot substitute for actual adoption. A burn mechanism often sounds impressive, yet it is only as strong as the business activity behind it. Investors should always trace value support back to real user behavior. Poor tokenomics tends to fail for fairly predictable reasons. Overinflation can dilute holders by pushing too many new tokens into the market. High token velocity can create constant sell pressure if users quickly dump rewards or have no reason to hold the asset. Weak utility means demand may never become durable, leaving the token dependent on hype. Concentrated ownership can distort both price behavior and governance outcomes, especially when a few wallets control major decisions. Fragile designs also tend to break under tougher market conditions, when speculation fades and only real economic value matters. In short, tokenomics problems often show up first in behavior and only later in price. A simple rule for evaluating tokenomics is to ask whether the token has durable reasons to be used, held, and supported. Use requires real utility, not just a vague promise of future relevance. Holding should make sense because incentives are sustainable and because there is some reason not to sell immediately. Support means the broader ecosystem, including governance and participant behavior, helps the token remain functional over time. To test that, review the token's purpose, supply growth, distribution, incentive structure, and concentration risks. If the design depends mostly on hype, rapid price appreciation, or constant new buyers, it is usually weak. Strong tokenomics gives people reasons to stay involved even after excitement fades. Section 4. Supply and emissions. Supply and emissions are two of the most important parts of token analysis. Supply tells you how many tokens exist now, or may exist eventually, while emissions tell you when and how quickly new tokens enter circulation. Together, they shape scarcity, inflation, dilution, and market expectations. They also affect incentives because new issuance is often used to reward validators, miners, stakers, or users. A token can look scarce based on its headline supply, but still face heavy dilution if large emissions are scheduled ahead. That is why investors need both the quantity and the release schedule. Looking at only one gives an incomplete picture. There are three supply measures investors should keep separate. Maximum supply is the hard ceiling, if one exists, showing the most tokens that could ever exist. Total supply is the amount created so far minus any tokens that have been permanently burned. Circulating supply is the portion actually available and tradable in the market right now. These numbers are related, but they answer different questions. Markets usually react most directly to circulating supply because that is the supply participants can buy and sell today. If you mix these categories together, You can easily misjudge valuation and future dilution risk. Circulating supply matters most because it reflects what is actually available in the market. A project might have a very large total supply, but if much of it is locked for the team, treasury, or investor vesting, those tokens are not yet part of active market supply. Over time, though, those locked tokens may unlock and become tradable, which can increase sell pressure. That means a token can look stable today while carrying meaningful future dilution risk. Using total supply instead of circulating supply can also overstate current market value if the locked portion is not yet available. For investors, this is why vesting schedules and unlock calendars are not minor details. They help explain what supply could hit the market later. An emission schedule tells you how new tokens are released over time. Some projects put nearly all supply into the market at launch, while others release tokens gradually over months or years. Issuance may stay constant, decline over time, or continue indefinitely. Two projects can have the same eventual total supply, but very different market effects because the timing of release is different. Front-loaded issuance may create heavy early dilution, while slower schedules spread that impact out. Permanent issuance may support network incentives, but it also means inflation never fully disappears. For investors, timing matters as much as amount. Several common emission models show different trade-offs. Fixed supply means no new tokens are created after launch, which gives strong supply certainty but may reduce long-term reward flexibility. Disinflationary models still issue new tokens but at a declining pace, often through step-down mechanisms like halvings. Linear inflation adds tokens at a steady ongoing rate, which can be predictable but creates continuous dilution. Tail emission keeps a small permanent level of inflation indefinitely, aiming to preserve incentives for security or participation without very high long-term inflation. None of these models is automatically best in every context. The right design depends on what the network needs and how demand develops over time. Emissions matter because they directly affect both holders and the network itself. Fast supply growth can dilute existing holders if market demand does not absorb the new tokens. At the same time, issuance can be useful because it helps pay validators, fund adoption, and support ecosystem growth. Low emissions reduce dilution, but they may also weaken incentives if participants are not rewarded enough to secure or build the network. High emissions and low emissions both involve trade-offs, which is why simplistic rules can be misleading. Investors should ask whether the issuance being created is helping the network enough to justify the added supply. The best answer usually sits somewhere between extremes. Supply design is not just a price question. In many proof-of-stake or similar systems, inflation helps fund staking rewards, which encourages token lockup and supports network security. If emissions are too low, participation may weaken because the rewards are not attractive enough. If emissions are too high, holders may become frustrated by ongoing dilution. Governance adds another layer because token holders may be able to change issuance rules later, creating policy risk. A network that looks moderately inflationary today could become more inflationary after a governance vote, so investors should evaluate both the current supply design and who has the power to change it. Supply changes over time through a sequence of rules and events. At launch, a project sets caps, issuance rates, and lockup conditions that define the broad structure. After that, tokens may be minted per block, per epoch, or on another regular schedule. But minted supply and circulating supply are not always the same because some newly created tokens may stay locked, vest gradually, or sit in treasury accounts. Burns can remove tokens from supply, yet they may only partially offset the new issuance. As a result, the actual market impact depends on more than just how many tokens are minted. Investors need to follow the path from issuance to circulation. The Zeta example shows how dilution can affect price if demand does not grow. Suppose Zeta starts with 200 million circulating tokens, a 1 billion maximum supply, and 10% annual inflation based on that maximum. That creates 100 million new tokens in year 1, or about 833 million per month. If all of those tokens enter the market, circulating supply rises from 200 million to 300 million. If market capitalization stays flat during that period, the price per token must fall because the same total market value is spread across more units. In this example, A token priced at 50 cents would drop to about 33 cents. To keep the original price, market cap would need to grow enough to absorb the larger supply. Before investing, do not stop at a single headline supply number. Separate maximum supply, total supply, and circulating supply so you know what exists, what may exist, and what is tradable today. Then check future unlocks and vesting schedules, because these often matter more than the current supply figure. It is also a mistake to assume fixed supply is always superior, since some networks need moderate issuance to support security or participation. Burns should be treated carefully as well, because they may sound attractive while being too small to offset new issuance. The real goal is to understand the full supply path over time. That gives a much clearer view of dilution risk and valuation than any one number alone. Section 5. Incentive Systems. Digital networks work only if participants keep doing useful things reliably. Incentive systems exist to encourage those actions, whether the task is validating transactions, providing liquidity, storing data, creating content, or participating in governance. At the same time, good systems discourage harmful behavior such as spam, manipulation, fraud, poor performance, or carelessness. In effect, incentives are the rules that help turn individual self-interest into network function. When they are designed well, the network becomes more resilient because helpful behavior is rewarded and abuse becomes costly. When they are designed poorly, the opposite happens and participants learn how to extract value without contributing much. That is why incentives are a foundation of digital economies, not a side feature. The central goal of incentive design is alignment. Ideally, the action that is most profitable for an individual participant should also be good for the network. If people can earn rewards through fake activity, spam, or shallow engagement, then the system is misaligned even if it looks busy on the surface. Good design creates accountability so that rewards reflect real contribution rather than easy-to-game metrics. This is one reason crypto systems often combine transparent rules with measurable on-chain actions. A healthy network makes helpful behavior rational and harmful behavior expensive. For investors, alignment is one of the clearest signs that incentives may hold up over time. Many token systems rely on both rewards and penalties rather than rewards alone. Participants may earn direct rewards for specific actions such as validating, staking, contributing resources, or helping the ecosystem grow. They may also benefit indirectly if token ownership gains value as the network becomes more useful. But there is usually downside as well. Slashing, lockups, reduced access, or lost rewards can penalize dishonesty, missed obligations, or core performance. This mix creates a form of self-regulation because participants have both upside to pursue and downside to avoid. For investors, that balance often tells you whether the system encourages responsibility or simply hands out tokens. Time horizon strongly shapes participant behavior. Short-term rewards, such as airdrops, bonus payouts, or high initial yields, can attract attention quickly and help a network gain users early. But they can also attract opportunistic participants who leave as soon as the rewards are claimed. Longer-term tools, including vesting, lockups, staking commitments, or loyalty programs, try to keep participants engaged over a longer period. These mechanisms can reduce churn and encourage people to think beyond immediate extraction. Of course, they also add friction, so the design has to be reasonable. The key question is whether the system attracts committed contributors or mostly temporary reward collectors. Designing an incentive system usually follows a repeatable process. First, the project identifies which behaviors are actually valuable, such as validating, voting, storing data, or supplying liquidity. Then it sets reward parameters, including how much to pay, how often to pay, and under what conditions. Distribution is often automated through smart contracts, so the rules are applied consistently. Penalties are added to discourage harmful behavior or failure to perform obligations. Finally, the system has to adapt over time, because participant behavior changes and static rules can become outdated. Strong incentive design is not just about generosity, it is about paying for the right actions in the right way. Sustainable incentive systems live in the middle of several trade-offs. If rewards are too high, the network may attract activity quickly, but dilute token value through heavy emissions. If rewards are too low, not enough participants may show up to make the system work. Penalties have similar trade-offs. If they are too harsh, honest users may avoid participating because the downside feels unreasonable. If they are too weak, bad actors may decide abuse is worth the risk. The goal is a sustainable zone where participation is attractive, abuse is discouraged, and token economics remain credible. That balance is difficult, which is why investors should be cautious of systems that look too generous or too punitive. Incentives can be gained whenever rewards are tied to metrics that are easy to fake. A classic example is a Sybil attack, where one real actor creates many fake identities to collect rewards intended for a broad group of participants. Other systems get exploited when they reward clicks, transactions, or activity counts that do not reflect genuine value. Static rules can also become easy to exploit once participants understand exactly how to maximize rewards with minimal effort. That means a system can appear active while actually paying for low-quality behavior. Investors should always ask whether rewards are hard to fake and whether the rewarded actions truly strengthen the network. If not, the incentive system may be funding extraction rather than growth. Filecoin is a useful real-world example because it ties incentives to actual storage performance. Storage providers earn fill by contributing storage capacity over time, so rewards are linked to useful participation rather than a simple fixed payout. Those payouts are algorithmic, which means they depend on measurable network conditions and contribution levels. Providers also have to post collateral, giving them something to lose if they fail to meet reliability standards. If obligations are missed, slashing or related penalties can reduce earnings or impose losses. This combination of upside and downside is designed to encourage dependable service. For investors, Filecoin illustrates how token incentives can support a real operational market, rather than just distribute rewards loosely. Weak incentive design often looks attractive early because rewards can create fast activity and strong marketing narratives. But several mistakes tend to cause trouble later. Overrewarding early users can concentrate benefits in a small group and create later sell pressure. Ignoring friction can limit real participation if the system is too hard or costly for normal users to join. Another mistake is assuming issuance alone creates demand, when in reality printed tokens often just increase supply without creating lasting value. Rewarding the wrong metric is also dangerous because participants will optimize for what gets paid rather than what actually helps the network. Good incentives shape valuable behavior, not just token distribution. This practice exercise brings the chapter together by asking you to design a simple voting incentive system. Imagine a token-based platform with a fixed annual reward pool of 1 million tokens and decide how those rewards should be allocated. You would need to choose whether every vote earns the same reward or whether voting power should be weighted by token holdings or some other rule. You would also need an anti-Sybil defense, so one person cannot split into many fake accounts to farm rewards. Finally, pick a penalty for users who skip participation for a month, such as reduced rewards or a temporary restriction. The real lesson is that fairness, security, and participation often pull in different directions. Good token design is usually about balancing those pressures rather than maximizing just one of them.